Awesome, awesome. Hello, everybody. Welcome. This is the Derivatives Podcast. I'm Rosalie from Panoptic, and I'm joined here today by Guillaume Lambert and Nathan Burks from Panoptic, as well as Andrew from Block Scholes. Welcome, everybody.
Hello. Very good to see you guys again. Been a while.
Yeah, thank you for joining me. We are going to go over your recent research report. So we did a joint research report with Block Scholes and Panoptic on gamma scalping and our new vaults, and just figuring out what is going on in Uniswap and how we can kind of profit off of these market inefficiencies and really analyze what's going on with these LP positions. So I would love to kind of just dive right into it and start with that LP positions are generally short convexity or short volatility, and that kind of gives this specific gamma scalping trade an edge. And I would love for you guys to explain kind of in simple terms what that means and how that affects how liquidity is provided in Uniswap.
Yeah, I'll give it a go in simple terms. I think worth taking it back to basics on how Uniswap works, and then hopefully we've got a good foundation for the rest of the chat. When you deploy liquidity to Uniswap, if you're not just trading, then if you're a liquidity provider, you're providing liquidity in two assets. You end up having a portfolio of, let's say, Ethereum and USDC. You supply both to the pool, and you let people trade against you. So in essence, what we mean by short convexity here is that you're short optionality. You lose the choice of whether someone is trading against you. So in real terms, it ends up that as a provider to Uniswap, you, in the case I described, Ethereum against USDC, you end up accumulating more Ethereum when Ethereum's price is going down against USDC, and then the same in reverse. You end up accumulating more USDC, you're selling your Ethereum in your portfolio as the price of Ethereum goes up, as more buyers come in and hit against you. So short convexity just comes from the mechanics of how Uniswap has LPs provide liquidity, and it ends up that your payoff profile, your portfolio value as a function of the spot looks curved to the downside. How's that for simple enough? Okay.
Yeah, that makes sense. I think in traditional markets, you can kind of take both sides of this volatility trade, right? But here, kind of, you can only really be a short volatility on Uniswap. So this imbalance kind of creates this opportunity, and that's kind of like the key point of the trade, right? So just explain that a little bit more. Now the other side to this trade.
Yeah, so why would anyone on Uniswap ever do this? It's because you get paid trading fees. You get paid for providing that liquidity, and you get paid every time someone trades against you. Well, the way that Uniswap is set up is that every time someone trades with the pool, the price moves around. So you end up being short volatility. You get paid when people trade against you in compensation for that. So you have two sides to your LP position trade. You have, okay, my portfolio is swinging around unfavorably as a function of spot, but I get paid some trading fees at the same time. I'm essentially market making, buying and selling, and facilitating trading in the market.
And is this kind of tie into the reverse gamma scalping? I think there's gamma scalping and reverse gamma scalping. So what is that? How do LPs lose money? And yeah.
Well, with LPs traditionally, like if it functions as a de facto short perpetual put option to hedge it, it's like a dog chasing its own tail. You're amplifying volatility while profiting from dampened volatility, if that makes sense. So the more you hedge, like for a perpetual put option, as the price moves down, you have to sell more and more. So you're amplifying that downward pressure, and convert and ironically exaggerating the exact effect that you're trying to keep contained or that you'd rather be contained. And on a broader scale, this is what you're seeing because you couldn't take the opposite side of the trade until Panoptic. On-chain IV, that continual selling pressure where LPing would just continually sell, or LPs would continually sell this optionality. It depresses the IV curve. So as a result of that, IV trades at a relative discount. So you're incentivized to be long optionality, but you couldn't do it. There wasn't an infrastructure to do it until Panoptic came on the scene. So that's where it's like LPs are being properly compensated, and gamma scalping is just bringing that mismatch to fruition, allowing you to capitalize on the mismatch that has been occurring systematically for years now, really.
And I'll add to this as well is that these type of inefficiencies happen all the time in traditional markets. Sometimes you have a structural need for setting options, could be a covered call, could be some level of hedge for commodities. And these is easier to trade in TradFi because you can take the other side. You see someone selling at any price, you can buy it cheaply in a way. If you try to do the same thing currently in DeFi, it's pretty much impossible to take the other side. So this kind of maybe not the battle, but the interactions between one side, which is perhaps selling convexity, and the one that could buy it, normally would restore and make the returns be a bit more aligned with the market. In the case of Uniswap and before Panoptic, there's no one to take the other side. So you have this structural imbalance, and opening up that market means that anyone can do that trade. We can make a vault that makes this easier to perform, but the key point is that that trade is impossible to carry out unless you have a protocol like Panoptic. So that's kind of the key point is that most markets need some efficiency level to be optimal, and without half the market being present to express their view on volatility, directionality, then you have kind of an incomplete market.
Very interesting. Yeah, I think in DeFi, there's definitely a lot of space still to grow and kind of become a more efficient market, like the traditional finance has done. I think on some of the research that you guys did, you looked at ETH USDC LP positions from 2024 to 2025 using reverse gamma scalping, and where these positions would have lost around 46%. And I'm just curious to kind of understand what that means about how volatility is priced in AMMs or in Uniswap.
Yeah, so worth delving a little bit deeper into exactly the mechanics of the trade that we were simulating. When we say reverse gamma scalping, these terms, I always forget exactly which way these are around. What I mean is hedging an LP position on Uniswap with some position in the underlying asset. So I deposit Ethereum and I deposit USDC to some smart contract on Uniswap or some other exchange, and I go and hedge my USDC exposure. I don't hedge my USDC exposure. I hedge my Ethereum exposure by going short Ethereum somewhere else, for example. And then as trading moves the price around, correspondingly moving my ratio of assets in my portfolio around, then I go and adjust my position in spot, my short position in spot, to remain hedged, right? This is the process which we're calling, I guess, reverse gamma scalping, because I make and lose money as a function of volatility during that process. If I'm short convexity, then when spot rallies higher, I end up with less USDC, which means I need to go and buy more Ethereum or short more Ethereum to hedge my position. And then I end up doing the reverse at the other side when spot sells off. So being short convexity means that I am a buyer at high prices and a seller at short prices, which costs me. It's a bad trading strategy in general, right? Balancing that against the fees that we would then collect from trading on Uniswap, this is the strategy we're comparing. So two cash flows, both dependent on realized volatility, one paid as a function of trading fees on Uniswap, the other from locking in some hedge and dynamically adjusting it. So this is the strategy we were backtesting. This is the one we were comparing across different pools, across different fee tiers, across different token pairs. The fact that doing this just raw on Uniswap as an LP and then hedging a position, the fact that it loses money, if it does that systematically, then it tells us that the fees being paid by Uniswap are systematically too low for the risk taken on by LP positions. Now, let that sink in a little bit. That sounds quite familiar under different terms. I think it's previously been called impermanent loss, which is just another way of saying I'm short convexity, but without getting into too many tough option terms. So yeah, that's what it means about the way Uniswap is pricing volatility.
That makes a lot of sense. I think there's a lot of just yield chasing and collecting fees or farming and different sources that have created yield in DeFi. And I think currently a lot of these yields have, dropped in profit significantly and seem to not really be long lasting yield and just short hype. And I think DeFi has kind of a big problem with yields at the moment, and people are kind of realizing that now and trying to kind of figure out how we can really create real yield for users, whether that's the Athena trade, the basis trade, or covered calls and cash secured puts and other option products or derivatives. I think that the appetite has definitely shifted and people are kind of taking a closer look at where yield really is coming from. Do you think that the DeFi landscape is kind of ready now for these derivatives and for these vaults, and we'll see more growth there? Or do you think that people are still kind of just on this yield farming hype?
Hype, a very relevant term there, intentionally or not, I guess. Is DeFi ready for a new yield product? I think DeFi will always be ready to go and chase yields, as you said. I think this one is potentially more sustainable than some of those that we've seen previously. Certainly some of the staking and restaking loops, which are essentially just hidden leverage, right? But ultimately, our view, I mean, it's in our name, Block Shoals. We believe in options, and we believe in options as a sustainable yield generation source. It's how it's treated in TradFi, and I think that's roughly the same way you guys are thinking about it.
Well, and also being long volatility. I look at everything through the prism of with a strategy. Does it have a positive skewness, payoff skewness, or a negative payoff skewness? And most of the popular, and Guillaume's talked about this at length on Twitter, these commoditized trades, be it the Athena trade or these prior DOV strategies, they're consistently incremental gains only to suffer major drawdowns and major losses. And this goes the opposite way with positive payoff skewness. There may be consistently large, or not large, but incremental losses, but then there are huge spikes in the payoff, so to the upside. So that's a property of going long convexity and offshoot of going long convexity. And when you have this structural imbalance and there's really no infrastructure to correct it, like Panoptic is allowing you to monetize it, to capitalize on it, but I don't think we can necessarily equilibrate it. So, which is a good thing. We want this consistent money printing engine to go on ad infinitum. So So when you have long vol, that it in itself is a differentiator, but when there's a well that never runs out, or so we hope, that adds another layer to it entirely.
To your point, I think it's strange to have a yield generation strategy which involves being long convexity or long volatility.
Mhm.
And I think that's, yeah, correct me if I'm wrong, I think that's a product of this structural one-sidedness in this position taking on Uniswap.
Yeah, I would say it's
Uh,
100% structural in that nature. And also want to take a few steps back, because when you look at yield now, it's maybe the most sustainable yield is Athena's basis trade, where you do have a need for going long on per exchanges and supplying that liquidity. Take some risk, but then you get paid with the funding rate. So as long as there's a need to hedge to go long, then that trade will be sustainable. If you look at lending and borrowing, you have a similar source of demand, pay interest rate, get leverage. But when you think about optionality and volatility, it also adds a new axis. And it might not be obvious from the beginning, but you can trade volatility, you can have needs for protection, you can also kind of structure a demand that is going to be sustainable because you are using options in a way that, again, the perp funding rate helps traders. The options premium or difference between realized and implied volatility is also serving a purpose. And without this maybe extra layer, everything is quite linear, meaning you borrow, you go long or short, you have a direct impact. When you do it with options, there's multi-axes. You can go many different ways, and you can optimize little corners of the volatility surface if you want. And that will mean that you have a lot more opportunities for yield. There's one instrument that does ETH arbitrage, again, funding rate arbitrage. There could be 5 different instruments that are different aspects of an options volatility surface. So it's not just creating one product or one strategy, it's just creating a new ecosystem. And in TradFi, as Andrew mentioned, it's quite rare you can benefit from being long convexity because it almost looks too good to be true. You have unlimited gains, limited losses. But because of the structural inefficiencies of DeFi and Uniswap or LP positions, then this is a profitable trade. So overall, we expect that the realm of strategies will expand greatly by having a very liquid options market. And getting there is first targeting the lowest of hanging fruits is, hey, this seems to be a very skewed market, no buying, a lot of selling. Then this is a strategy that allows users and also kind of vault participants to tap into that as well.
I think that you guys have mentioned a lot of different things about realized volatility and implied volatility and kind of these market inefficiencies there. And we call it the unicorn trade, the panoptic gamma scalping vault. And that trade is very, very profitable at the moment because of this unique dynamic on chain with the variance risk premium, which is the difference between realized and implied volatility. And so, do you think that there's going to be kind of more or less opportunities of this unique trade and this growth as the market matures and as new options and new trades come in? What is this going to look like? And what has the research kind of taught you so far about that?
It's a tough question. I can't tell you what's going to happen in the future, but I think what matters is the exposure that you get for being long volatility and the amount that you are paying to be long volatility. So I think you framed it previously as realized volatility and implied volatility. This is how we would talk about it in traditional finance, TradFi kind of vanilla options. You have the volatility that gets delivered by the underlying asset over the period of time before it expires. And then you get the premium that you pay up front for taking that position. It's just the options premium, right? And the premium that you pay implies that a certain level of volatility will be reached in order that your P&L from gamma scalping would be roughly zero. You've got break-even volatility. That somewhat breaks down a little bit with a panoption or a panoptic instrument, where you don't have an expiry, you don't have an implied volatility, you don't have a premium paid up front. You still have realized volatility, and you still get your trading still provides you with a gamma scalping cash flow, but the analog to an implied volatility is expressed via, sorry about my notifications, expressed via Streamia. This is the trading fee that you get paid for being short volatility on Uniswap. In Panoptic, where you reverse roles and you become long volatility, you're a payer of that rate. You're a payer of that rate that is too cheap, right? So as demand for panoptions and as demand for long volatility increases, we'd expect the price to take that position to increase as well. When Nathan referred to equilibrating between those, it's not clear to us right now how much of a gap that will be able to bridge. But at least we're now able to take both sides of it. Ultimately, it could be the case that there's so much demand for this that the variance risk premium, as you called it, reverses. And suddenly there's so much demand for being long volatility on chain without an expiry that it suddenly makes sense now to go and mint LP positions and rent them out.
That sounds very, very
That
interesting.
would be a very nice problem to have.
Yeah.
Campaign problems.
Yeah. If the volume's sustainable enough to where the unicorn trade is winnowed down, I don't think we're going to be complaining.
Of course not.
I think there's a lot of different components to this unicorn trade, and kind of what you guys were doing in the research to trigger the rehedges, something called delta bands. And so you infuse the delta bands as components of the strategy to rehedge or to trigger this rehedge. Could you explain to me what the delta bands are, how important they are in capturing this revenue, and what other alternative methods can be used to hedge with this type of strategy?
Yeah, I can tackle this at least from the first part. This is a question of how much you're able to lock in your gamma scalping P&L, or your gamma scalping cash flow, let's say. In traditional finance, in vanilla options, this is generally more of an art than a science. Ultimately, if I'm long volatility, I want to be rehedging my delta as often as possible. Every time there's a small move in spot, I accumulate some curvature to my portfolio that I want to go and lock in and take the profit on. And then I want to do that again as it moves slightly to the left, right? In an efficient market, that makes a lot of sense, and I'll do that as often as I am able to click the button or get an API to execute. But there are trading fees, there are all sorts of inefficiencies, there is slippage, many reasons that over-hedging becomes an issue. So when we're referring to delta bands in our research, in the backtesting, we're talking about simulating a rehedge or rebalance of the delta hedge whenever the delta hits some threshold. So we're not overdoing it, we're not underdoing it, we're doing it somewhere in the middle. What is the optimal way to dynamically rehedge delta positions on options? It really depends. In practice and in theory, the answers are different. I don't know how are Panoptic looking to do this in the vault structures. Is this something that's implemented automatically?
Yes, we have a. So again, the parameters means that you need to reduce the risk, and the best way to reduce the risk is to get rid of the exposure. You want to be neutral or market neutral, and you could click, as you said, Andrew, but you have to do this 24/7. And if you do it every price move, this is a bit like loss versus rebalancing almost, but you would be hedging every single trade. That's a lot of clicks. What we do on the Hypervault implementation is we have a hedging module, if you want, or a module that looks at the portfolio, looks at how much exposure it's getting. And if it's time to hedge, then it's a very simple hedge step that happens inside of Panoptic itself. You can actually short an asset. You can borrow and swap it if you want. So you could actually implement these hedges in a way that is fully in situ. So you don't have to split your collateral to go on a perp-dex exchange somewhere else. You can do it all on Panoptic. So that criteria of how frequently you hedge is quite important. We don't want to overhedge, but then having this be done automatically and in protocol reduces the risk and also makes it kind of a lot more efficient in terms of returns as well.
In practice on Panoptic, is that netted across many user positions?
No, yeah. So again, the goal of gamma scalping is that we have some convexity, whether it's a single option that we purchase or 1,000 of them. It is the beauty of options. You can combine all of them and get one set of Greeks. What's the delta? What's the gamma? Theta? All of this, but it's one single number, even though it's an underlying containing, again, dozens, if not more, of positions. So the goal of that gamma scalping hedger, if you want, is to look at this one number, and regardless of how many underlying positions you have, you know that if the price moves 1% to the left or 1% to the right, you know what the impact is going to be. So you can actually now hedge, and you can even predict when the price reaches that level, it's time to hedge. So yeah, it's all part of the hedge funds and quant traders do the same thing. So now we kind of commoditize this and make it available for all using the Vault infrastructure.
That's very interesting. I think in the research as well, you guys, in the simulation, in the ETH-USDC, it was a 5 bips pool. It showed that if you buy and hold, the return had been about 31%, but the return of the gamma scalping trade returned 219%. So there's a huge difference, 31% versus 219%. Incredibly profitable in the 5 bips pool. And in the 30 bips pool, there were little less returns. So kind of how does the fee tier affect this trade, and why is there such a huge difference between buying and holding and gamma scalping?
This is actually one of the most interesting parts of implementing this via DeFi, via on-chain. Anyone who is familiar with gamma scalping, with dynamically hedging delta from TradFi, from vanilla options, will have a slightly outdated, misguided view of what that would mean to do on-chain on Uniswap. And that's because of the microstructure of Uniswap being fundamentally different to how an order book system would work. Price does not move as a function of orders on Uniswap. It moves as a function of trades, which means that the only way a price gets updated is by someone coming and executing a price and pushing it up. So I push the price of ETH up against some other token. So you're fundamentally relying on arbitrageurs taking the price from one exchange and updating your price, quote unquote, updating on Uniswap by buying one place and selling the other. When the Uniswap price becomes stale, there's now an opportunity to go and trade between the two. I sell the price that's too expensive and I buy the price that's too cheap. And I move the prices more in line. But when you introduce fees to this, you have a speed bump, if you will, or a sort of minimum price level or price delta between those two exchanges before it's worth an arbitrage's time and money to go and execute the trade. So prices on Uniswap, they move stepwise. I mean, it's true for centralized exchanges as well in some degree, but they move stepwise. And those steps are larger. The larger that speed bump is, the more you require an arbitrager to wait before the price is stale enough to make it worth updating. That has a really interesting effect on volatility. Now the price that you're able to go and hedge against in your off-chain position or your off Uniswap position, now that price is jumping around in a fundamentally different way on a micro scale. This becomes very relevant when you're hedging, I guess, every trade and every block. I guess you can sort of abstract it a little bit as you zoom out and maybe hedge every 5 minutes or every time your delta moves around a little bit. But volatility is a different beast here on every scale in a Uniswap pool.
Yeah, and this was laid bare in our delta band apparatus. What would be optimal for the E5 bips pool, which was 5 delta weekly options, shifted to 15 delta weekly options for the 30 bips pool, and for the BTC pool, I believe it was 10 delta monthly options. So it just goes to show pool microstructure is a key component in the universality, I guess, of the unicorn trade. It has to be carefully curated. Because otherwise, like with the wrong parameters set, you could end up it could very easily reverse on you, and you could take huge losses. So something to bear in mind. But yeah, as long as that mentality is maintained from pool to pool, with it each, it's not a one size fits all. Yeah, the underpricing of volatility still applies.
And maybe if I want to add, you mentioned Bitcoin and ETH, and it seems to work with all of them. But then we did touch on some exotic pairs, and maybe you can touch on that. But it feels like it's a universal phenomenon in a way that gamma scalping can be exploited. So again, if you can talk about the more exotic pairs that we tested.
Yeah. In the meme coin pools, they were I mean, not quite as profitable as the 5 bips ETH, but in Pepe or Shiba Inu, Uni, these all had very promising results as well. But once again, it's not a one size fits all as far as even with those pools. And I can't remember off the top of my head as far as the delta parameters, um, but yeah, the choppiness, the price choppiness in those pools was very conducive to gamma scalping. So as meme coin pools typically are. So you can, I mean, we're curating it for our users in the vaults, but this could apply to any pool across the board. I mean, BTC had the worst results, but I think that was ultimately a volume issue, because the fact that monthly options were the most conducive to gamma scalping in that pool, that didn't apply to any other pool.
Yeah,
Weekly shorter term option. Oh, go ahead.
You touched on I think Pepe and Shiba Inu. We also looked at a wide range of more exotic tokens. I like this way of calling them. The real unlock here is that you can now go and take long or short convexity views on anything that has a pool active on Uniswap. This is an immediate unlock by leveraging Uniswap's infrastructure. So yes, you have exotics like Pepe against ETH, against USDC, but you can also do the same idea, long or short volatility of Ethereum versus something like Bitcoin. If there's a pool here, you can take a view on the volatility between the two. Even if options on that pair do not trade on centralized venues. And to be frank, very few options trades actually have liquidity worth talking about beyond majors. Although we're doing a pretty good job of moving into altcoins, I guess, now, and gold and oil and all the rest of it. Yeah, this is kind of strange. I mean, why would you expect one pair to do better than the other? I think we do find a correlation between outright volatility levels and discrepancy between our analogs of implied vol and realized vol. That generally seems to be the case in traditional finance, where you have more volatile assets are more routinely mispriced, or options on those more volatile assets are more routinely mispriced. And I think that carries over here. And I think we found that in the research as well.
Yeah, I think you guys definitely did a really good job on this research phase. I'm really excited about the unicorn trade and the upcoming Panoptic vaults. And it's interesting to see for me as well. It took a while to really understand that this is just market inefficiencies that give you an edge on a trade. And as the market matures, there will be less opportunities for this. And so right now, with the way Uniswap works and where we're at in DeFi, is a huge opportunity that most people are not aware of yet. Most LPers might not even understand their take on volatility and kind of what this opportunity really is. And I'm really excited kind of to see this trade come to life and how profitable it is. And I think we're kind of out of time, but I would love to kind of know how you guys plan to expand on this gamma scalping research. What's coming up next from Block Scholes, from Panoptic, and just kind of get some parting thoughts.
Kind of an open question. I think we're yet to decide. One thing I would love to do is find a way to go and price what vanilla options markets are implying for Streamia and how it gets paid by Uniswap positions. So we have information from vanilla options markets about what volatility is expected by the market for any assets, mostly for Bitcoin against stables or ETH against stables. I want to know what information can we leverage from that to go and identify opportunities on Panoptic.
Yeah, it's more so based on, okay, we've done, I would say, I guess volatility arbitrage is subjective, but this is one form of it in absolute terms with gamma scalping. But I think what we're looking to do with the next installment is more relative value based and seeing how the volatility surfaces compare from Panoptic to more centralized venues, and seeing those relative areas of cheapness or richness and how that can be capitalized upon cross-platform. And I mentioned to Guillaume the other day, we're already seeing earmarks of this, even following Bullet, formerly Zeta's Discord chatter. So other people have honed in on this, including crypto options market makers, without us even advertising it yet. So I think there is firm demand for this as well.
And also, like we're preparing for Panoptic V2 that makes the vault infrastructure much easier to deploy and manage. So that's kind of one product that can serve a lot of users. But we also have an SDK and a way to be self-directed in a way. And again, forgetting about the clicking, but you can also automatize some of these strategies. And when you talk about cheap convexity and gamma scalping, and you talk to this about TradFi options trader, they get it immediately. It's a natural kind of trade or instrument. They get the inefficiencies, and for them it's easy to say, all right, whether it's a exotic option, perpetual option, barrier, whatnot, I can understand that trade-off, which is cheap convexity allows me to hedge. And the other side, if there's a lot of demand for buying it, then I can sell the other side. So all of this is kind of bringing what is a quite mature ecosystem of traders. Again, Jane Street, Citadel, they all make a lot of money on the option side, but then bring this to all tokens in all of DeFi. It's a bit kind of a grand maybe goal, but the key point is that it's bringing some efficiency, or at least some more mature trades to DeFi. That's going to be extremely important, I guess, in the future as well.
Yeah, considering the persistence and the structural barriers to winnowing out the arbitrage, I like to think of it as, and then once again, this might be a little grandiose, but like the kimchi premium of convexity, and we're bringing it to the masses. It's not just an SBF level trade. I know it's sacrilegious to say his name, but yeah, it's not. Yeah, yes, I should cross myself.
He's gonna get out of jail soon, President Powhatan is gonna be able to be on the podcast and talk about this.
Yeah. We'll ask him how sustainable.
I mean, the original if you think about DeFi back in the day of that character, you had liquidity mining. A lot of folks got paid by providing liquidity on Uniswap. And if you think about this, this is just subsidizing the IV. If you just look at the trades and the fees, it's typically not enough. So you print maybe a worthless token, but that is an extra revenue that is, in a lopsided ways, making the market efficient. In the current world, which is not maybe easy to print as much tokens and survive long, this is a new opportunity for, could be a team launching a token or some fund that wants to extract yield, but it's another way, another parallel way to kind of restore this imbalance that was identified in 2021, 2022, was wildly successful, collapsed in the wildest of fashion, and now it's kind of, maybe we can bring it back. That's kind of the idea.
It sounds great. Yeah, we will be bringing it back. Thank you so much to all of you guys for joining, and thank you to everybody for listening. And yeah, I think this was great. I hope you guys all have a wonderful day.
Thank you, guys.
All right. Thanks, you guys.
Bye.